Hey everyone, Couch Investor here with another video for you today. Today I'm filming this after the market, well, actually was pretty good today. I think it jumped over 1,700 points, almost reached 2,000 points. It reached the limit up in intraday trading. So yeah, was a good day today because people expect that the government will reach an agreement on the package that will stimulate the economy and help companies. Now, I took this day as an opportunity to actually sell some of my stocks that actually surprisingly weren't down during the crash. So I sold them so I get a little bit of cash because I'm sure that today was green, tomorrow might be green again, but we will see red days anytime soon because we're not out of the trouble yet. So that's why I want to make a three-part video on three stocks, all in the same category that I think you should take one of the three into your portfolio. It's a high risk but very high reward stock. It's about the cruise lines stocks: Carnival, Royal Caribbean, and Norwegian. Now, all three of them lost 70%, 80%, 65% from their all-time highs. Now, they're really undervalued. So today I'm gonna start with Carnival Cruise Lines. So at the time of making this video, Carnival Cruise Lines are at $13.66. Might fluctuate, might be $12, might even be $14. It depends what day you're watching this video and the day the video will be online. I'll make sure it will be tonight or even tomorrow. It has a PE ratio of 3.18. Again, might fluctuate. Dividend yield at the moment is 50 cents per share. Now, because of what we will discuss here, they might cut the dividend for a year or so because they will need cash. Because, well, the reason the stocks of the cruise lines have dropped drastically is because, well, nobody's going on cruises anytime soon. So they might cut dividend for a time being because they might need the cash to pay off debt, etc. Now, the uh, PE for the last 5 years, the next 5 years, is 18. Why is this number important? For the end, we'll do a little calculation, and you'll see why I think it's a must buy. Now, they had an earnings report. It actually missed by 5 cents, but it beat a revenue estimate. But that was before the coronavirus outbreak. But still, good to see that they beat the revenue estimates. Now I'll start going into a very technical financial aspect. I don't usually do this in videos, but I think in those kind of stocks, you actually need to see the balance sheets and all the financials behind the company. So please bear with me. Now, the cruise lines, I'll show you a picture. They're very nice, very luxurious, etc. Now, they have over 1,500 voyages, trips that are spread at around 100 destinations worldwide over, I think, 40 countries or so. Last year, there were 30 million people that went on cruises, and 5.2 million of those chose to go on Carnival cruises, which is not bad at all. The peak of the stock this year, well, actually it peaked a long time ago, but this year the peak was at $57, $58. So as you can see, if you buy now, if it goes back to the all-time highs, you might like quadruple your money, which is not bad, but high risk. Because who knows, maybe they will go bankrupt. The government decides not to have a package to help those big companies like airline companies and cruise lines, etc. Like I said, it lost approximately 78% since they're all-time highs. Now let's go into the financials. Now, cash, they have $518 million in cash. They had a revenue of $20.8 billion. Cost of revenue was $12.9 billion. Gross profit was $7.9 billion. Now, cash and assets, again, 518 million cash. Receivables were 444 million. Inventories, 427 million. Then prepaid expenses was 671 million. All in total, $2.5 billion. Now, important categories, the non-cash assets, meaning tangible assets, the ships, everything they own. First thing, property equipment, $56 billion, which is the largest from all three, from Royal Caribbean and Norwegian. Carnival has the largest fleet, actually. It had obviously minus 18 billion in depreciation on cruise ships last year. So they made their non-cash assets net is $38 billion, which comes at around a total asset plus cash at $42 billion, which is a lot, but you'll see why it's good that they have so much in assets and cash, because they might need it in situation like this. And I explain why in the liabilities. Short term, it's $8.1 billion. Long term is $10.5 billion. Short term meaning in the next 12 months. Long term in the next 5 years, let's say, which is a total of $19.6 billion. Gross margin of 38%, with operating margins of 15%, which is nice. Royal Caribbean has around, I think, operating margins of 19%, which is the highest of the three. Liability breakdown. So let's break it down. Short term, 1.8 billion. Accounts payable, 756 million. Accrued liability, 1.8 billion. And then, important one, deferred liability, 4.7 billion. Then you can see I put on two totals. Basically, one with deferred liability, one without. Because deferred liability means that that's the amount of money that they still have to collect. Now, let's say now with the coronavirus situation, they can't collect that. Well, maybe it shouldn't have been under liabilities, because that money might never come. So that's why we have two totals. One is $9.1 billion and the other one without it is $4.39 billion. Now, it's very important to know that lots of people have booked already their cruises for this year, and I don't exactly know the policy of the cruise line, but they might maybe offer to like a voucher for next year. If they offered refund, then obviously they lost the money that they could have been receiving for 2020. But I had a flight in 2 weeks and I got a voucher from the company, meaning the company still has my money, so it's still in their books, and obviously I will spend it. So I think it should be a good move for cruise line companies and airline companies, etc., to offer a voucher, so at least you still have the customer and that money in your balance sheet, which would be good in this situation, because most of those companies really need the cash right now. Then they did 603 million in stock repurchasing last year. I'm strongly against that, certainly now, because they're basically using our money to buy their stocks again. I would strongly prefer them to use the money from stock purchasing to invest in their own company instead of buying the shares all over again, which makes no sense actually. Sometimes, yes, it might drive the price up, but then what? Nothing. They just spent a huge amount of money that they could have had for cash, for securities, I don't know, investing in their own company, or dividends, let's say. They spent $1.38 billion in dividend. Now, that's a lot of money, because as you can see, they had $9.1 billion of, let's say, liability debt that they have to pay eventually. And that's why I think they might cut off the dividends, because, well, it's a large chunk of money that they can save up in the meantime. And then, let's say, when everything goes back to normal in a year or two, they put the dividend back again. Obviously, I would love to still have my dividends, because as of now, I think it's around 15% or 14% dividend yield with the price as of now. So current valuation is between 8.9 billion and 9.5 billion, depending, well, at the price of the share. Earnings in 2019 were 2.99 billion, so almost 3 billion. So valuation versus previous earnings is 2.98. Now here comes the big calculation. That means that earnings and valuation, earnings was almost 3 times that, and becomes the valuation of 8.9 or 9.49, depending on the price and, well, the last financial report that you watch. So that's why I put the average there. Now, current reflection of earnings in regards to the PE that we mentioned at the beginning, the 18, the PE of 5 years. All of that comes at around $495 million earnings in the current state, when you know that actually now they had almost $3 billion in earnings. So if you calculate, I'm not going to put the calculation here because it's a lot of numbers, but if you calculate, if, let's say, it comes back to the state it was before, it could rise hypothetically, it's very bullish, to around 600%. That's if you take it currently, and then it goes back to the all-time highs of $57, $58 with the revenue and the earnings and everything that's supposed to be if everything runs as usual. Now, that's one of the major reasons why I think I would invest not a lot of money, because it's still very risky. Yes, today it went up 20% or 30%. It can very well go back down to around $9, $8, fine by me. But for me right now, the price is very, very cheap. It's very undervalued. And even if it goes back down a little bit, I'm sure that in 5 years' time, if you can quadruple your investment, most of us will be very happy with that. So all I can say is high risk, high reward. Think about it, but don't buy it just because I said that it can quadruple your investment. I'm just saying people after this situation will still go on vacations, will still take cruises, and the company, if they survive, I think there's a high percent chance that they will survive, that they will be back in 2 years' time at the situation where they were 1 year ago, 2 years ago, 3 years ago. So in the next 2 videos, we'll talk about Norwegian Cruise Lines and Royal Caribbean. If you want me to cover, I don't know, airlines or whatever, leave it down in the comments below. Stay safe, wash your hands, like, subscribe. See you in the next video. Bye-bye.